Shadow banking does not operate in darkness. It operates outside the frame. The term does not describe secrecy, but structure. Over the past 2 decades, a parallel financial system has grown alongside traditional banks, performing similar functions without the same oversight. It lends, borrows, leverages, and intermediates capital, yet it does so through vehicles that fall beyond conventional banking regulation. This system did not emerge by accident. It expanded as regulation tightened around banks after successive crises. Risk did not disappear. It relocated. Today, shadow banking channels trillions of dollars globally, shaping liquidity and credit conditions in ways that remain difficult to measure in real time. This is the story of the system behind the system and why its visibility matters only when stability is tested. Shadow banking refers to non-bank financial institutions that perform bank-like activities. These include money market funds, hedge funds, private credit funds, structured investment vehicles, and certain insurance-linked entities. Unlike traditional banks, they do not accept insured deposits and therefore are not regulated under the same capital and liquidity frameworks. The growth of shadow banking accelerated after the global financial crisis. As regulators imposed stricter capital requirements on banks, financial activity migrated toward less regulated entities. Investors seeking yield found opportunities in these alternative structures. Borrowers found capital outside traditional channels. The shadow system is not marginal. In many jurisdictions, its assets rival or exceed those of regulated banks. It plays a central role in funding corporations, real estate projects, leveraged buyouts, and financial markets more broadly. Its defining characteristic is not illegality, but structural distance from deposit-backed banking. That distance creates flexibility. It also creates opacity. Shadow banking sold efficiency. Without the constraints imposed on traditional banks, non-bank institutions could allocate capital faster and more flexibly. Investors were told that innovation and diversification would reduce systemic concentration. Private funds promised tailored financing. Structured vehicles promised risk redistribution. Money market funds offered liquidity with slightly higher returns than traditional deposits. The system appeared adaptive and modern. The broader promise was resilience through decentralization. By spreading credit creation across multiple entities rather than concentrating it within banks, risk was assumed to be distributed. Regulation, in theory, had made the course safer. This belief encouraged growth. Borrowers increasingly relied on private markets for financing. Institutional investors allocated capital to vehicles that operated outside traditional banking structures. The promise was not the absence of risk, but containment. Because these entities did not hold insured deposits, it was assumed their failures would not destabilize the broader system. That assumption would be tested repeatedly. The rise of shadow banking was gradual but persistent. Low interest rates after 2008 amplified demand for alternative yield. Institutional capital flowed into private funds and credit vehicles. Asset managers expanded into direct lending. Securitization returned in modified forms. This growth reshaped the credit landscape. Corporations increasingly borrowed from private lenders rather than banks. Real estate financing moved into debt funds. Leveraged buyouts relied on syndicated and private credit structures. Shadow banking entities often relied on short-term funding markets or leveraged structures of their own. Repurchase agreements, derivatives, and structured notes became tools for capital efficiency. As long as markets remained liquid, the system functioned smoothly. Regulatory oversight struggled to keep pace. Because these entities were fragmented and often cross-border, supervision remained indirect. Data collection lagged behind innovation. Shadow banking did not overtake traditional banks. It intertwined with them. Banks provided credit lines, prime brokerage services, and derivatives exposure to shadow institutions. The two systems became mutually dependent. The rise was not dramatic. It was cumulative. Over time, shadow banking became an essential component of global finance, shaping credit availability without operating under a unified regulatory framework. Shadow banking fails differently from traditional banks. It does not face retail deposit runs in the conventional sense. Instead, it experiences liquidity shocks through funding markets and investor withdrawals. During periods of stress, short-term financing can evaporate rapidly. Money market funds may experience redemptions. Repurchase agreement markets can tighten. Investors may demand cash from funds holding illiquid assets. Because many shadow institutions rely on market-based funding rather than insured deposits, confidence plays a central role. When asset values decline, margin requirements increase. Forced selling follows. The fragmentation of the system complicates oversight. No single regulator has complete authority across all entities. Risk may appear manageable at the firm level while building collectively across the system. Examples have emerged repeatedly. Structured vehicles in 2008, money market stress during periods of volatility, leverage embedded in private funds. Each event revealed similar dynamics. Liquidity assumed, funding conditional. The system fails when funding chains compress simultaneously. What appears decentralized can become synchronized under stress. If banks are exposed through credit lines or derivatives, strain transmits back into the regulated core. The vulnerability is not fraud or recklessness. It is correlation. When multiple actors depend on the same liquidity conditions, diversification becomes illusionary. Shadow banking does not require secrecy to generate instability. It requires confidence in continued market access. When that access narrows, the system can contract quickly, redistributing stress into traditional banking and public markets. Shadow banking does not collapse in a single event. It contracts through episodes. Funding dries up, leverage unwinds, asset sales accelerate. Authorities often intervene indirectly. Central banks expand liquidity facilities. Regulators coordinate to stabilize funding markets. These measures are designed to protect the core banking system from spillover. Because shadow institutions lack insured deposits, losses are absorbed by investors rather than taxpayers in direct form. Yet indirect effects remain. Reduced credit availability slows economic activity. Asset price volatility spreads. The collapse when it occurs is partial and cyclical. Segments of the shadow system shrink. Others adapt and reemerge under new structures. Shadow banking rarely disappears, it restructures. The aftermath of shadow banking stress typically results in targeted reform rather than systemic overhaul. Disclosure requirements may increase. Leverage limits may tighten. Certain vehicles may be restricted. Yet capital continues seeking yield. New structures replace old ones. The boundary between regulated and unregulated finance shifts, but does not vanish. Shadow banking persists because it fulfills demand. Borrowers need capital. Investors seek return. Regulation creates incentives for activity to move. The system adapts faster than oversight. Shadow banking is not a hidden conspiracy. It is a structural consequence of modern regulation and market demand. When constraints tighten in one area, activity relocates to another. The risk lies not in its existence but in its scale and interconnection. A system that operates beyond traditional oversight can function efficiently during stability, yet amplify stress during disruption. Shadow banking reminds us that financial systems evolve continuously. Regulation shapes behavior, but does not eliminate risk. It redistributes it. The question is not whether shadow banking will matter in the next crisis. It is how.